Well, good morning, everyone, and welcome to another GemCap Academy. And I have the greatest pleasure of introducing one of my oldest friends in the industry, someone I've known far too long. We were mere children when we met, but it's my pleasure to introduce Mark Dampier. Morning, Mark.
Morning, Stuart. Yeah, we were mere kids.
Well, I remember I was a very young, youngish fund sales guy with Gartmore back in 1987, just around about the crash time. And I think you were working in Teddington, I think?
I was in Teddington. Yeah, you're right. Yeah. Well, I used to live as well.
And I met you and I never forget, we went to a pub near your office, and I remember sitting in a children's playground area, like a kiddie slide.
That's right.
I'll never forget that. I can't remember what I did yesterday, but I can never forget that.
It's funny how you remember those things. I mean, that was such a long time ago. Yeah, I remember it was a lovely day as well, sitting out there and whatever. And yeah, I remember it really well.
And a lot of things, our lives have gone off in different paths. You're now sort of semi-retired, doing a bit of non-exec work. Obviously, I'm running the GemCap business. But way back then, 35 years ago or so, the industry was very different. I mean, things have changed in those 35 years, not just
a bit. I've got a lot of grey hair.
Yeah, I've got a few more pounds. But the industry's changed a lot. I mean, what do you think over the last 35 years do you think has been good for the industry? That must be good stuff that's happened over the last 35 years.
Oh, yeah. Well, there's one really, really obvious one that people won't realise, because, of course, I've been in the industry 40 years. So when I first started, there was no regulation. There was you could just set yourself up as an advisor, and people did. I mean, most of the advisors came from the insurance brokers, not insurance, but insurance companies. So Allied Dunbar. They do their salesmanship at Allied Dunbar, and then set themselves up as, well, they weren't called IFAs. You just called a financial advisor. And actually, what they did was they carried on selling single premium insurance bonds. Yeah. And why? Because they got, what, 5, 6, 7% commission. Unit Trust would only pay you 3% commission.
But you had to be a stockbroker. We only remember the early days. We only.
Oh, that's true. That's true as well. Yeah. So that was a big thing. And in those days, about once a week, an advisor would go off with client money, because they would mix client money into an account, into their business account, because there was no regulation. And so I have to say that has to be the biggest change, that you've got regulation. And in fact, when was the last time you don't see many advisors going off with client money now? Right. Very occasionally you see something, but the regulation has stopped that. But the most obvious thing over 40 years is, I would say, the professionalization, which I think just the people I see now, particularly over the last 10, 20 years, I look at the financial planners I see I'm a great Twitter person, as you know.
Oh, yes. Oh, yeah.
They are seriously good. I mean, they are, and they're quite, and they take exams. I mean, there was no exams when I first started. There was nothing.
I remember, as a fund sales guy, going to see financial planners or financial advisors working from living rooms in tower blocks in Wembley. Not against tower blocks or Wembley, but it was not the professional industry that it is today. Whereas to become a financial planner today, you've got to sit lots of different exams, and it's good to see. I mean,
it is. I don't knock it. I think it's really good. I think where it hasn't got, where they've had problems, is that from a graduate point of view, it's quite hard to get younger people into it. I don't think the industry sells itself there extremely well. And people don't think about financial planning as a sort of career. But then maybe they didn't think about it in my day when I first started. I just came to it by accident anyway. And I thought you had to be a stockbroker or a life insurance salesman, basically. And I didn't realise you could do this sort of in-between bit of planning and funds, which in those days were really open-ended. We're talking about unit trust. And that's what started to really interest me.
Yeah, it's interesting that how the industry has changed in that sense. I mean, I think all levels have got more professional, even in the fund sales arena now.
Yeah.
You've got it. In fact, even in the investment management teams, you just have people. I remember I was at Morgan Grenfell back in 88, 89, and they would only take on board fund managers, trainee fund managers from Oxford or Cambridge.
Yeah.
And I said, that's ridiculous. You know, what about Bristol? What about Leeds? What about Manchester? What about Liverpool? You know, so on and so forth. And they just didn't consider it. I mean, thankfully now we've got much more diversity and inclusion, not just in the gender sense or diversity elsewhere in race, but also in social background. And it's fascinating to see the difference between industry back 35 years ago, when you had the Barrow boys coming out of the East End, and then you have the Surrey set.
Yes.
Very, again, a very diverse, but extremes in the industry for that sense. But that's now changed. And thankfully, we've got a lot more inclusion in that sense.
Yeah.
What do you think, you know, taking the good things, the changes, what do you think of the things that haven't worked within the industry? Where do you feel that we still got room to improve?
Well, communications, probably. It's always comms and content on whatever, because investment is straightforward in one sense of the word, but everyone else seems to make it really complex. And we talked earlier before we started the interview about application forms. I always remember Peter Hargreaves actually getting a Standard Life pension form, and I think it was 35 pages. And he said to me, and he sat in front of me and started tearing it up and said, "Here's the 2 pages you actually need." And he said, every page, every time you turn another page, you lose another 10% of investors on an application form. So simplifying it, and I think a lot of that's happened, and it's much easier now, but we still don't. You know, I talk to people like Holly Mackay at Boring Money, and she'll say, you know, asset managers, do they really communicate that well still? Well, I don't think so, personally. I think they could do a lot more. I spoke to a group with a very good income fund recently. I was trying to help them, and I said, you've done this report, and you're an income fund, and nowhere in this report have you mentioned dividends or income or what you've done. And I said, don't you think that's sort of extraordinary? Because I know it's an income and growth fund, but it's got income in there, and people are buying it because they want a 4%, maybe, you know, the sort of yield 4 or 5%. And we've gone through COVID where dividends have gone down. We've done this and all that, and you've not talked about it at all. So
I mean, the challenge, as I've always seen with the fund industry, is that, again, going back to my days as a fund salesperson, my job was to sell the product to you, you know, as the intermediary in the 2 firms, actually 3 firms I've known you at. But we never, as a fund business, we never enabled the intermediary to sell it to the end user. We always struggled with that. And I always remember going into a number of IFAs who would have that. There was an M&G chart that showed the FTSE, or sorry, the all share, I think it was, over 100 years or something, and that was their sales aid. That's the reason to buy equities. And they'd show the Wall Street crashes on 29, it showed 73, 74, and so on, and then obviously post 87 as a blip. And
well, Stuart, people are still using that, and I saw a planner use it the other day because they were going back 20 years and they had a chart. He said, I send this all to our clients because he had a Gulf War. And I understand why he was doing it, because he said there's always a reason not to invest, you see. But maybe we'll go on to it later, but I just think we're in an interesting time in markets. And I think one thing that the industry gets hooked up in, we all do, because it's a psychological thing, is we all get trapped in our own history as well. And the truth is, at my time, because I spent, when I sort of packed in a bit, before I packed in, I started looking back, and really and I did a presentation at HL about this, and I said, well, I've had basically my 40 years is a long duration bull market in bonds, because when I first started, US Treasuries yielded 15%. Gilts similarly, and they basically went from there to what in 2020 down to about 0.6. So I said, when you're comparing, don't look at all the crises that happen like Gulf War. The biggest thing is that, and that's what's put. We've basically had I would say we've had a 40-year bull market, which has been interrupted by sort of cyclical bear markets, but we've had this huge fall in interest rates, and mathematically you can't repeat it. So the next decade or so has got to be somehow different. I'm not sure I'm clever enough to tell you exactly how, but it isn't.
Give me your crystal ball, please.
It isn't going to be, but it isn't going to be quite. It is going to be the same, and so I think all of us have to be careful about using back charts and saying, well, you just invest and get on with it, and that's fine, because I don't think it's I don't always think it's quite as simple as that.
No, but I mean, just referencing that chart there, I mean, the relationship between asset managers and fund buyers has changed over the years, no doubt about it. I mean, I couldn't go on and do fund sales anymore. I'm too old and grey and not smart enough to go and do that. But do you think the relationship needs to develop? I mean, it has changed, you know, the relationship that you've experienced. Do you see that continual change? And if so,
well, I don't see what I've had. I don't see so some of us oldies, because all us oldies all go back and say, well, we had the good old days and whatever. I mean, things change and you just kind of have to accept that. But I do feel sorry for the youngsters kind of in the industry today, because I used to be a kind of, I hate the word, but networker.
Yeah.
You know, used to go out and do all sorts of things, and people would sometimes say to me, well, why are you doing that? And I said, well, surely you want to meet as many people as you can, because, you know, over my 40-year career, you see them again, and sometimes they come up with great ideas. I mean, other intimate. I mean, one thing about the industry is, generally speaking, it's a great sharing industry.
Yeah.
You don't find that in many other sectors, and people do share and say ideas, and if it works for them, and I notice it with intermediaries today, with planners saying, well, this has worked really well for me, you know, why don't you try it on whatever? And I think that's really good. But the biggest opportunity lost, and I think that's a regulation thing, is the ability to network like you used to be able to, because so much has gone. I mean, I could use the word corporate entertainment, but it's gone completely. We've gone from one part to another, and the youngsters say to me when I was at HL, the graduates, they just don't meet anyone, and they kept on saying to me, "Well, how come you know all these people? How come you know, I don't know, Martin Gilbert at Aberdeen or whatever?" And I'm thinking, well, yeah, but I met him at Cat.
You know, Martin Gilbert, Mark. That's not special.
Yeah. But you know what I get. Martin's just one example of people, but people you meet and they just don't see anyone. And I actually think the industry's, if it's not careful, it's sort of going backwards a little bit in not talking to people. And if it's a talking industry, it's communications, and if you don't meet people,
there are exceptions. There clearly are exceptions. In fact, I was in London on Friday and met up with a few people. And a big shout out to Lee Robertson at Octo.
Yeah,
he's
very good.
Going back to your point there about sharing. You know, Octo's got that route.
Exactly.
But equally, when it comes to fund salespeople, we used to do, you know, we have lunches and stuff. And I always remember doing lunches with you and Peter Hargreaves, and there'd be three of us sharing the bill, because there'd be somebody from, you know, this firm and that firm and me, and we'd all dib in, but we collectively learned a lot from each other.
Exactly.
And I think the fund salespeople today are missing that, but their fund sales skills have changed. I was never a technical sales guy, one could argue, but today the positioning of a fund isn't say, oh, my fund's the best thing since sliced bread. You've got to really position it. You've got to understand it. You've got to know where it sits against its competitors, not just in the peer rankings, you know.
Yeah, I agree.
The tables, really where it sits, and knowing you've got to know your competition inside out, so you can position your fund against it, either as a direct competitor or something which complements the fund. And I think that's changed. And so there's a lot more research goes in, from what I see, and I speak to a couple of fund sales guys who are still out there, and they're finding more and more time doing in-house research on that competition before they go out with their own fund. Which
it's something I always used to. I think it made sense. I used to say it to them. I said, "Well, okay, so you're telling me this income fund. So how does that sit with this competitors?" In fact, I used to say sometimes it's great to sell your competitors' fund as well, because you say, "Well, why not? This fund links with this fund, and it works well." I mean, sorry, as we're talking, do you know, apart from the regulation thing, the biggest change is, I think we're seeing now, and you'll probably hate me for saying this, is really the change into different vehicles and passive. So, I mean, the rise of ETFs is just unbelievable, and I can't see it stopping. And passive as well. I mean, the fact is that active managers have got to work so hard, and passive investment and management fees have gone down so much that it's a real struggle. I mean, I was looking at two funds the other day. One was Fundsmith. Everyone knows Fundsmith. And one was Blue Whale. And I used to work with Stephen, the fund manager. And by God, he's a hard worker. I mean, really fantastic worker. But they've had explosively great times initially. But when I looked over the last, I think, 5 years or so, suddenly you look at a passive investment. I think it was HSB Tracker. I can't remember which. Global Tracker basically done the same. Really? For taking probably less risk. Now, to be fair, they both, markets change, and it doesn't mean that will stay like that. But that's a huge change in that you've got cheap, very cheap passive. And frankly, if I had a go at management, I mean, management fees have come down. Well, they've gone a hell of a long way down from where I was, but they're still too, when your competition is passive, you've got to work a hell of a lot harder. And I don't see much of that.
I mean, I will shout out to you, because I remember having an interesting conversation with you about 20 years ago about pricing of funds. In fact, I nearly fell out with you. So I was bloody fuming about it. I was stewing for weeks, because we had this great conversation about corner shops and Tesco's, and why are you selling at this price? Where are Tesco's? It's obviously when you've gone to HL, and I have to say, all credit to you, Mark, at the time, because you held your argument. You have helped be instrumental in driving down costs in the funds industry, the fees. We had all these, obviously, I think HL were one of the first people to get a retrocession on the back. And of course, as soon as one asset management did it, I think it was Henderson's who did it initially.
Yeah.
And I said, "Oh, we're not going to do it." And the next thing, poof, they're all doing it. But you helped drive down those, getting rid of initial commissions, and the average fee now. When we talk to a fund manager and we say, "You're coming to the UK market, do not look at the US, do not look at Europe as a barometer where fees are. We are significantly lower in the UK than many other places for active funds. Passive, probably we're on a par, but looking now at 65, 70 bips for a UK fund, possibly lower if you've got volume. Compare that to where it was.
Oh yeah,
double that easily.
Yeah, I think they're going to about. Well, I mean, we could get Nick Train when I was at HL at under 60. In fact, I think it was about 54.
Oh, he's such a tart, man. God, he gives it away.
Well, all I'm saying is I think that's where you've got to be going that way, because the competition on passive is so difficult. And unfortunately, being a fan of active management, I'm sort of, but I can't help but look at passive. And actually, I was talking to someone else and he was saying, well, I look at finding the best active fund, and then I see if there's a passive alternative and see how well that's done. Yeah. And that's the asset, that's the competition that's happening at the moment. And the 40-year, I talked about the 40-year sort of long duration market. And what I would say is that it's completely favoured passive, because it's favoured just market beta. That's what you really needed to buy, market beta. Yeah. So passive has done spectacularly well. And I say to some of the IFAs who just look at passive and they don't look at anything else, and say, well, okay, guys, but don't necessarily presume that's going to carry on. But every time someone says it's going to be the year of active. It never is, because active managers are trapped in the history as well. And it's really hard to do something away from a benchmark.
It's fascinating because I was part of the group that launched passive funds into the UK with Morgan Grenfell, UK Tracker, in 1988, end of 88. No one wanted it.
No,
literally no one wanted it. Well, why we want passive? Of course, now is a different story. But you mentioned a fund manager earlier on, Terry Smith, who I had the pleasure of working with a long time ago in the early 90s. Now he was very vocal about fund charges when he launched Fundsmith.
Yeah, he's forgotten about it though, hasn't he?
Now he was talking about this, you get to a certain size, then you change the feature, and funny enough, he's not done that.
Funny that, isn't it? When the money starts coming through.
No, when the result, he's like, hang on, I'll pay for another boat in Mauritius somewhere. But
it does make me, because I like what he does, and he's just done his investment conference, and I think that's a great way of communicating with the actual, and he's a great communicator, he's a great marketeer, fantastic in every sense. But like a marketeer, he has a convenient memory lapse, and just before he launched Fundsmith, he cascaded it. He said the industry wasn't taking the economies of scale, and as funds get bigger, they should come off. And I thought it's a fair point. Why shouldn't you?
Should we be innovators? Should the fund industry be sitting back and saying, you know what, if a fund gets to X, we've reached the economy that we need to get to, and there are obviously significant costs to running a fund. But yes, it's blooming cheap to run a fund. It's not. The regulations and the levels of regulation just make it more and more expensive. Now, there's some efficiencies coming through with technology, although some of them are a bit slow. But there must be a point. If you've got a 5, 10, 15 billion pound fund, you're pulling in some serious revenue there. Now, do you think we should be looking at innovative ways of making it cheaper for investors with a bigger fund, or will that create a situation which I personally don't like, is where boutiques who've got smaller funds, more nimble, more active funds, are at a disadvantage on price because everyone's driven by price and not performance?
Well, the trouble is, it's really a combination of all those things, isn't it? Really. Well, we used to say best fund managers. We used to think of we tried to think of it as the best fund manager at the best price. If you want, I mean, it's a difficult one. Terry just said recharges should come down. Well, obviously his fund went up to 28 billion. I think it's about 22 billion now, and he's still charging 94 basis points. And hell, he doesn't get any problem with the investors because he's delivered a great performance in that respect. But he's hardly poor, so you kind of think that you might be able to reduce the charges down. I mean, I have to say, it's also an argument I had at HL, because I think we should have been doing the same thing, by the way. But I think the charges should start to come off. And I also think the fund management group has to decide how big the fund needs to be, because it's all very well have economies of scale, but there's also, can the fund manager run a huge amount of money? Now, it's a big blue chip global fund. Okay, it's not going to be a big problem, but if you go complete opposite and look at a smaller company fund, you probably don't want to get that to more than about $1 billion. No, really, in reality. So there has to be some kind of flexibility around all that. I don't think there's a one. There's no. Anytime you can find an investment rule, you can normally break it because it's just a grey area. But I think that. But I think we should be trying to drive prices down for investors. I've always felt that was the right thing to do, and which is why I was always generally against things like performance fees. Which
I'm not a big performance fee. If someone comes to us with a fund which's got a performance fee, well, I said good luck with that one. You can still buy, but it's pretty all gone now. Let's just change tack slightly. We talked about innovation in technology in the marketplace, but innovation as far as products. I mean, we've all jumped on this bandwagon in the last few years on ESG, and I remember some years ago I was at Insight, and we had a very, very strong SRI team. That was Steve Waygood, who's now at Aviva, and his team were excellent, really, really good. and Steve Waygood is very good at what he does at Aviva. But back then, I went out in the market and canvassed a few IFAs and who had their SRI above the door almost, and they said, "Oh, we only buy if an investor asks." Today, the investors are asking, and there's a big change. But there's obviously this greenwashing issue. To stay ahead of investors' demand, where do you think that we as a funds industry, where we're lacking that innovation and the ability to anticipate what investors should be looking at? Do you have any thoughts on that?
Well, the trouble is, my thoughts are I'm not a great fan of ESG. And I'm not 100% convinced that everybody's searching for it. And also, can I say, it's a label that in my day we used to have ethics. So we had ethical funds, is what you're really talking about. So we had, and so we had sort of light green, dark green, those who did this, and then we'd have an ecology fund or whatever. And if I put a sales hat on, not anyone was particularly fantastically interested. Now, clearly, things have changed in that way, and I appreciate the fact that people don't necessarily want to invest in like tobacco stocks or whatever. I completely get that, but I think the ESG label it's just but that label has tried to capture all of it into one thing, and I just don't think you can pigeonhole everything. I mean, you know, someone said, well, you want to buy good companies. I think, well, I've never met a fund manager who wants to buy a bad company. You know, so, you know, and governance, we get all that. And yes, does a company want to be highlighted because it's using slave labor in, you know, Africa or something? Well, no, and nobody wants to buy that. But the whole ESG label, to me, has gone too far. The industry's picked it up because the industry, I'll be a bit cynical here, sees a way of selling funds, and where passive finds it slightly more tricky.
I agree. I'm slightly with you on that cynicism, but then again, you've always been a cynic. That's why we get on. But there are certain areas. So if you want to go and promote a fund into the Nordics, into Sweden and Norway and stuff, you have to have a fund which is ESG, and that's driven by government initiative. So obviously the state monies demand that you are the SFDR 8 or 9, and that's a tall order. The problem is sometimes we work with managers and we can't get them to an 8 or a 9. It's just that it's literally their investment process, their philosophy can't get them there. They want to get there, but they can't. It's just almost impossible because it's so demanding. But I just wonder whether or not there's, you know, what do you think? I'm not suggesting you've got a crystal ball in front of you. You may well have, but where do you see, what do you think is the next level? Where are we going to next? Not on ESG, but generally, what do you think is the next hot thing coming around the corner?
Well, things like ESG funds that actually are, I mean, I think the mutual industry is in danger of ESG swallowing them all up, and you'll have ESG funds because, you know, go back to, I'll just call them unit trusts or OITs, whatever you want to say. Is it, in terms of tech, isn't it amazing that we still have one pricing point? We have a forward pricing point, which just seems to me, and particularly young people who, most youngsters love the idea of buying shares or whatever, at least initially. They often go off the boil later when they find out it's not quite as easy as they thought. But they are ready to sort of snap. And the idea of saying, well, yes, the market's doing this, but you could buy this fund, but you'll get the price tomorrow at 12 o'clock.
Yeah.
Kind of just, I do struggle with that.
I agree. We're looking at tokenization. So tokenizing the funds.
Right.
So that means you trade 24/7 and you get a price.
Yeah. Well, that's where I kind of think the mutual industry kind of needs to go. And if it doesn't, it'll just get swallowed. It'll get swallowed up by everything else. I think we'll have, and I think we'll have active, EFG. Active type funds in that area. But so I think that'll be a big change. I suppose the other thing is, I might have said this 20 years ago, I can't believe we haven't seen more consolidation in the industry.
Managers.
Yeah, well, we've got too many, there's way too many funds everywhere. I mean, my God, it's absolutely ridiculous. And I include investment trusts. I mean, there's at least 200 investment trusts that probably need to go because they're too small. I mean, liquidity is really important for buyers, not so much for the man in the street who can buy a few £1,000s, but if you're a larger broker or whatever, funds of £500 million barely, they don't, you need bigger funds. Yeah. So the investment trust industry needs to look at that a lot more. And the open-ended industry just needs to make sure that it's still relevant. And the danger is that it won't be, because I think, it's all right, us old blokes, but you've got this younger class coming up, and you're right, they do look at more things about climate change and ESG. I do sort of get that. I think there's a danger of going completely wrong, and I would point out the ESG has not done a great job. It didn't look at the defence industry, which I thought was really odd. I always tell a story of R.J. Mitchell. R.J. Mitchell is the inventor of the Spitfire, and I said, well, so you wouldn't have funded him in the 1930s then to get the Spitfire flying. So I said that would have worked well, wouldn't it? And then we have a full-blown energy crisis because for some reason we want to invest in lots of wind farms or whatever, which are all terrific, but all just have complete intermittency, so there can't be a replacement of fossil fuels at the moment. So you're going to defund the industry that has taken us out of the dark ages. I mean, it doesn't matter what you say about fossil fuels. We would not have what we have today if we did not have fossil fuels. So we have a strange way of looking at a balance sheet. If you want a negative and positive sheet. And ESG seems to be, if it goes too far, just starts to defund things that you later need. And look at the defence industry. We've got a major European war, and I don't know what other things, but the Russians have got to be defeated. I mean, they're absolutely ghastly. It's a huge stuff going on. So ESG is the problem, I think.
It'd be more like a regime change, won't it? Rather than getting defeated. They'll get defeated, then going to be a regime change. But we don't hate to talk about politics, right? But I'm just going to draw our conversation to a close, because I'm going to throw you a little curveball.
Oh, right.
If you were to go back to that famous day when we met in that pub garden with the children's playground, if you could tell yourself what you know now, so it's literally, what would you tell your 29, whatever, how old were you then? 1987? Can I ask? Late 20s, I guess.
Late 20s, wasn't it?
Yeah. So what would you tell your late 20s self now, knowing what you know now?
I should have read a lot more.
Should have read a lot more.
Should definitely reading. I mean, there wasn't much. There's so little information in those days. Really, but from an experience point of view, I'd love to go back now with everything I know now, inevitably. And because the laugh is that, of course, they chuck all us oldies out of the industry just vaguely at the time when you might actually be useful, because you've got this thing called experience, which basically means you've made loads of past mistakes and you try not to make them again. But actually what happens is you get booted out and all the youngsters come in and make all the same mistakes, and the industry just goes perpetually, the financial industry just makes the same mistakes. There isn't anything much new. And the one thing and I'm asked, 40 years I've been asked virtually every year, what can we do for you? And I have a simple answer. As an active manager, you have to perform. And if you can't perform, you've got nothing. You can have the best marketing in the world, you have the best sales force in the world, but if your fund managers can't actually perform, and now when we have the most transparent industry. I mean, horrible being a fund manager. Every second you're looked at. What other industry? I can't think of many other industries where every second you're looked at all the time. So if you've got a unit trust, if you operate a unit trust, you're looked at. You could be checked every second of the day. Yeah. And not just by intermediaries, by media, everyone else. The pressure is huge.
It is, and that's sadly not going to change, I don't think.
No.
Mark, it's been lovely to catch up, and thank you for joining me today.
Pleasure.
Must do it again, because I'm sure
It's
there's
fun.
lots of things that we can catch up on. I'll continue to follow your rants on Twitter, along with my rants on Twitter, and we look forward to catching up soon. So thank you, and take care.
Thanks, Stuart. Been great. Good to see you.